Hello, and welcome back to this week's episode of Coinscrum Markets. I'm Nisa Amoils. Coming up, Charlie Magura returns for his monthly macro view in the markets in crypto RFQ. I'll be speaking to veteran investor Greg Kidd about his blockchain-based identity project, GlobaliD. Teana is joined by ITI Digital's Gene Moldavsky and Copper's Boris-Bilowitzki to discuss their company's exchange-traded products. And Philip Gradwell's back to look at this week's blockchain data in Onchain reaction. First, a look at this week's blockchain industry news. In Twittergate last week, shockwaves continued to reverberate. Coinbase came to the rescue of over 1,000 customers when it blocked their attempts to send a total of 280,000 to the Bitcoin addresses posted by the hackers. Not their keys, but still their coins. In DeFi, total value locked reached $3 billion after $2 billion just 2 weeks ago and surging volumes on DEXs. Companies are using innovative token economics and distribution models to offer a way for token value accrual derived from platform trading fees and use native tokens and liquidity mining provisions mechanisms to distribute tokens to users, bootstrap activity, and incentivize governance participation. Since Compound's success at decentralizing governance, many protocols are moving in the same direction. The delayed transition to ETH 2.0 presents an opportunity for scalable competitors to possibly gain market share. So DeFi yield wars will be followed by a resurgence of platform wars. In fact, Ethereum just passed Bitcoin in dollar value transactions per day. On the mass adoption side, MasterCard is expanding its card program with Wirex. Standard Chartered is getting into custody, and PayPal is working with Paxos on new consumer services. The European Commission released the second and final paper on a proposed EU framework for markets in crypto assets this week. UK trade body Crypto UK noted that the Commission had broadly listened to the industry and is proposing a bespoke regime for payment and utility tokens while not considering stablecoins as a form of e-money. Ziglu, the UK's multi-currency banking platform recently launched by former Barclays tech head and Starling Bank founder Mark Hipperson, announced this week that up to £50,000 of its customers' crypto balances will be insured, a healthy way towards the standard £85,000 covered for fiat balances held in bank accounts in the UK. And finally, New York-based crypto broker BitOoda has published an in-depth report on the state of Bitcoin mining in partnership with Fidelity. Their data was gathered from a survey of 131 mining operators from 20 countries who provide roughly 1/3 of the network's hash rate between them. Calculating a median electricity price of 3 US cents across the network, the report concludes a likely ongoing and significant increase in hash rate over the next 12 to 24 months that could lead to a $4.1 billion funding gap that the industry will need to raise from external sources. Don't forget to click and subscribe to our channel for more updates. Next up, Crypto RFQ. Hey, Charlie, welcome back. Thanks for joining us.
Hey, Nisa, thanks for having me. Always good to be back.
So what's happening with Bitcoin right now?
Well, it's tempting to say a whole lot of nothing because the markets haven't been very volatile. But I think under the surface, it's really quite an interesting setup trading-wise. So why don't we dig in? Okay, so here's our first chart. Really a remarkable chart. So this is realized volatility of Bitcoin since January. The white line is the shortest dated measure of realized volatility, and then the other ones are kind of different moving averages. And what you can see is that volatility in the market is actually lower than it was pre-COVID. It's just completely compressed, and down to like a 15-day, a 10%. Over the last 10 days, 15%, move, which is just unheard of as a low annualized volatility for Bitcoin. On the next page here, we can see that the low volatility is persistent across the whole market, but it's really most noticeable in Bitcoin itself. And Ethereum has been outperforming. In the yellow line here, you've got the Ethereum versus Bitcoin cross, and you can see that ETH is moving up. People are excited about DeFi. They're excited about ETH 2.0, but Bitcoin is just steady as she goes. So moving on here, there's still this kind of idea out there that Bitcoin is digital gold, but actual gold and actual silver, which are in the yellow and green lines respectively on this next slide, are really outperforming in recent months versus Bitcoin. And that kind of draws into question this idea of Bitcoin is this sort of like macro hedge, the super hard asset kind of only thing. It's like maybe it's not trading like that right now, and there's different theories about why that might be. Maybe we're still working off a kind of a post-halvening over positioning. Maybe it's something else that's going on in terms of too many people writing options, or who knows what. But it's really quite remarkable, especially in the context of a macro environment that's heavily favoring precious metals right now.
Right, and favoring them. What does that imply about the dollar?
Well, we'll get there in just 2 seconds. I just wanted to highlight on the next slide. With the recent spike in precious metals over the last couple of days, the institutional crossover folks have not given up at all, and they're positioning up in Bitcoin futures on the CME again. So that's sort of indicating kind of like no capitulation by macro folks kind of crossing over into Bitcoin. And then if you look at the dollar chart, which is the next one, here we have in yellow the inverse of the dollar. So higher means the dollar is weaker. And we can see as the dollar is weakening, and that tends to pull Bitcoin higher, but it hasn't happened over the last month. So that's really pretty notable, and I do think it will, put some kind of gravitational attraction to the top side in, would be my opinion. But it's just an opinion, as they say.
Okay.
So, yeah. Right now, in terms of the overall kind of macro environment, global growth expectations are starting to re-rate higher again. The EU managed to get a stimulus package put together, which the markets are interpreting quite bullishly, and parts of Asia appear to be bouncing in terms of economic activity. And what that's done is push the price of copper higher against the price of gold, and thereby reduce the gold-copper ratio. So if you think that global growth is going to pick up, it raises the question of, in the context of all this stimulus, with growth picking up, does that mean inflation might pick up again? And so what we have here on the next page is a chart of the silver price against swap implied inflation rates. And what it shows is that silver may be leading the inflation market higher. It's a much smaller market than the bond market, and therefore it's easier to move around. So definitely keep an eye on this space. If this rally in silver is persistent, it will tend to push up inflation expectations, or could be signaling rather that there is an uptick in inflation expectations, which if the macro story on crypto holds, should pass over into Bitcoin. Now, kind of related to that, just moving on to the technicals. Right now, it's been so slow in Bitcoin that kind of in terms of the longer dated technical chart, kind of the nearby really big levels are kind of in that like 9,000 area and 10,300 to the top side. So we're still kind of at the bottom of like where kind of the nearest anchor points are from a longer term technical perspective. And I would look for Bitcoin to fill in that gap pretty meaningfully to the top side.
All right. Thanks, Charlie. Thanks for joining us again.
Thanks, Nisa. Bye-bye.
Events such as the recent Twitter hack continue to shine the light on data privacy, with many in the blockchain industry arguing that a more decentralized web is all but inevitable. This week, I was joined by veteran investor Greg Kidd to talk about his latest digital identity venture, GlobaliD. Greg has had a long and distinguished career, starting with management consulting for the payments industry in the 80s, to building a very successful dispatch management software company in the 90s, followed by a stint as a senior analyst for payments at the Federal Reserve, then eventually entering the world of crypto as chief risk officer at Ripple. Greg also co-founded Hard Yaka Investments and became an early-stage investor in companies including Twitter, Square, and Twilio before leaning heavily towards crypto and blockchain startups, with a portfolio of companies such as Coinbase, Ripple, LedgerX, and TradeBlock. Welcome, Greg. Thanks so much for being with us today.
Thanks for having me.
So data privacy has started to seep into the public consciousness, whether Cambridge Analytica, COVID tracing, or the Twitter hack last week. And I'm excited to learn about GlobaliD and what it is about self-sovereign ID that is so important right now.
Sure. Well, the idea of self-sovereign ID is that you own your identity rather than a particular company or government. And so the particular form of self-sovereign identity we have is built on the concept of a namespace. So your identity is encapsulated into a name, just like you have a handle on Twitter or Skype, and all the attributes of your identity, all the verifications, the proofs are attached to that name. And you ought to be able to take that name anywhere you go and authenticate yourself and get authorization. So instead of having a username for service A and service B, you've got one username that you can use everywhere. And you can prove that you control that username, not with a password. I mean, you could use a password, that's not very secure, but you could have a token of that name on your mobile phone or a card in your pocket. And if you lose that phone or that card or it gets compromised, there's a way that your friends or other people you know could help you reestablish your identity on a new device. So once again, you don't have to depend on a single corporation or a government. So GlobaliD, our organization, is not the control of your name. It's just, and your identity, we're just the protocol that lets you control it yourself. And so at this time of increasing hacks, increasing concerns about surveillance, this is a new sort of way of thinking about identity that puts controls in the hands of the individual.
And can you talk a little bit more about the bottom-up approach and how you're using zero-knowledge proofs?
That's right. So once you get your name, and it doesn't have to be your actual name, think of it as like your handle, you go to various third-party services. You might go we might go through Twilio to confirm that you control your phone number. We might go to an Onfido or a Verif to show that you have taken the information off of a particular government ID, match the picture on that to a picture of your selfie, or through Plaid that you control a particular financial account. And what would show as part of your public record, it's like being in the white pages or the yellow pages, is that you've passed these tests. It doesn't show what your email address is or your phone number or your physical address or your bank account number. It shows that that's been confirmed by a trusted third party. And with those, for instance, you ought to be able to do the classic thing is go to a bar and prove that you're over 18 or over 21 without having to show what your birthday is. And so a zero knowledge proof means that that other relying party can ask a question, can get it answered without you having to give up the actual fine-grained private information about yourself. So it's enough information so you can get permission to act without actually having to share the underlying private information. And so this is enabling and empowering both people, but also developers to include these methods of authentication and authorization into their applications and websites, as opposed to having to build that from scratch and build a silo where your identity once again belongs to them. All these things can be done not just one site at a time, but across any site that participates in this new foundation.
Now, I know that you're working with Uphold, and I'd love to learn more about that partnership. Are you also working with Web3 Foundation or Blockstack?
So we know the Blockstack folks from early on, and so there'll be someone we'll look to do more with down the road. We just picked up Hold as a first use case because they have a kind of a couple million users. They work with Brave, and we thought that's a great way to take something that people are familiar with, a digital wallet. And again, the normal way of doing that, whether you're logging into a traditional Coinbase wallet or a TransferWise wallet, is you'd have a username and password that is associated just with that organization. You might have a second factor of authentication, which might be through like Google Authenticator or Authy, but it still is all built around one company at a time. this experience that we're doing with Uphold, even though we're starting with Uphold first, is portable. So once you get an identity that works with Uphold, you could, in theory, use that again elsewhere. And like a perfect example, another partner we're looking to work with, you'd be able, for instance, to identify yourself on the Brave browser in a privacy-preserving way, so that you could basically have your identity port around with you to like any site that you visited on the web. That site wouldn't actually know who you are, but they would know that the identity visiting that site has been verified, authenticated, is attached to a wallet, and could do things on the web that are powerful, but still in a privacy-preserving way. And so, you start with Uphold, but if you could imagine if anywhere you went on the web that was willing to take self-sovereign credentials, it would be like Amazon, one click, but for everything you could do on the internet. That's the vision, but we have to start somewhere, and Uphold was a great partner to start with.
Great. And that brings up Facebook's Libra or WeChat or Telegram.
Right.
And, how does that compare?
So we look out there in the world, and I would say like it's more likely that identity is going to come from a messaging app than it's going to come from a wallet app. And so I always think of the three clear potential leaders or winners already in this market would be like WeChat from China, Telegram from Europe, and then WhatsApp, which is based out of America but used around the world. Each of them have a messaging stack, a system of identity that could potentially become portable, but it's kind of like going back in time to the days of America Online, Prodigy, and CompuServe. Each of them could have become the internet, but they were each their own proprietary siloed standard. And AOL couldn't get CompuServe to do everything with AOL's protocol. They each had their own, and they basically just battled it out. It was the battle of the elephants. But then a protocol approach came along, which was the World Wide Web and the domain name system. And originally, the web was less powerful than any of those siloed services. But because it was an open protocol and it wasn't proprietary, that open protocol won out. And so that's the big question: is somebody like it's kind of like the Highlander, one sword to rule them all? Is WeChat going to vanquish Telegram and WhatsApp and become the standard of the world, or vice versa? Our observation of history is none of those folks are going to be able to like dominate over the rest. So unless there's an open protocol solution, each of those they have a big head start, just like AOL and CompuServe. But we're betting on the protocol approach, that a version of identity that's interoperable across the silos would be the only way that there could be a universal solution. But it's absolutely true that each of those firms, because of their size, their user base, their technological clout, can easily push their identity system, just like Facebook Connect is pushed it's a proprietary closed system, but my gosh, it reaches 2 billion people. And so that's the battle. We saw how it worked out in the 1990s. The World Wide Web came to be. Our supposition is that there could be, just like there's a domain name system, there could be an identity name system that is interoperable across all of those platform customer bases.
And Europe has been very proactive. In fact, last week there was a surprise ruling on US cloud services, and they've been more proactive with GDPR and privacy in general. What's your view on Europe?
So the Europeans are interesting because they actually view privacy as a human right, whereas in the United States, privacy is treated as a contract right, which you tend to sign away as soon as you sign one of those 50-page terms of use. And so they're way ahead in terms of thinking of privacy in a very human rights fundamental way. The problem is also Europe is quite bureaucratic. And so the construct behind GDPR is you give people fine-grained control of who they share their data with. But as you've seen, it's quite complicated having all these bilateral data sharing arrangements, which you then can revoke. So once you've shared your data, in theory under GDPR, you can revoke that sharing. But I don't think without a time machine that you can really go back and kind of unshare once you've shared something. Yes, you can ask someone to destroy it, but once the cat's out of the bag, it's a very difficult construct. This construct of the right to be forgotten is a nice construct, but I come from the Twitter world, and once you tweeted something, yes, you can untweet it, but once the public has seen it, it really is out there. And so the problem with GDPR is you still have all this private information moving around. The more efficient, more truly privacy preserving method, in our opinion, is to go to zero knowledge proofs and not share the data at all. Just share knowledge about the data and keep the data locked down, encrypted, in control of the people.
Speaking of Twitter, you're a longstanding investor, and Jack Dorsey's made his Bitcoin interest clear. Given the events of last week with the hack, are you having conversations with him about that?
Well, I haven't talked to Jack about it. Twitter still is it's been 15 years now. It's like a 15-year-old construct, and so Twitter still, like most legacy offerings, has this concept that your identity in Twitter is still like a user handle attached essentially to a phone number, and it's kind of the oldest trick in the book. If you do a SIM swap, and you can convince a rep at a Verizon or AT&T store that you lost your phone and you need a new one, and you're the person who's associated with that Twitter account, well, you're going to get, through a password reset, control of that Twitter account. And if one of those people that you do that for is an employee at Twitter who has access to like account control for key people, this is going to continue to happen. So as long as identity is still attached to something that is your phone number or your email address, that's a big attack vector. And until you move to a concept of identity where those are indicators, but that's not actually your identity, you're going to continue to have these kinds of compromises.
Well, given your experience as a highly, experienced financial risk officer, what are your thoughts on the recent blacklisting of stablecoin addresses?
Well, once again, I mean, you can blacklist an address. It's kind of like what's behind that address and who controls that address. And so, that's kind of a one step removed type solution. When I came to Ripple early on, I think I was the 10th person at Ripple as the chief risk officer, and which included compliance. We only had, there were like maybe 100,000 accounts or addresses out there. And early on, we could have at that time said, well, we ought to have identity associated with those addresses. But that was not the blockchain way. So you end up with this huge group of addresses, and you have essentially some idea, but maybe no idea about a lot of those. And it's always been a question. In the blockchain world, one of the key compliance issues is it's not for sending money. You could receive money from any other address. As long as they know your address, they can push money into your address. And that organization might be a terrorist organization. It might be a criminal organization. And you might say, well, why would they send you money? Well, once you start receiving money from a bad address, you look like a bad person.
Right.
It's really easy to set someone up to look like they're the recipient of a bribe or are involved in some nefarious activity. And so as long as you only have a system of public key, private key pairs, it's like a bearer bond system. Anybody who has the routing information can make things happen. And with no information behind who they are or why they're sending the money, it's very difficult to understand how that solution at scale could ever be compliant and not problematic. Blacklisting is better than nothing, but it really, if you think you're really going to be effective with that strategy and that's your primary method, there's some very unpleasant things that are going to happen.
And your thoughts on the DeFi hype the past few months?
Well, I mean, DeFi it's just, I mean, it sounds great. We just need to see what is going to be that killer DeFi app that really makes that like a household kind of phenomenon. And so I'm still sort of waiting and looking to see like what gets pushed over the threshold. So there's still, in my mind, a gap between the hype and having arrived. So
yeah, it's like a house of whales. Everybody's trading with each other in the same circle.
Yeah. So I'm looking for that. Like at Square, it was the food trucks when we could like service 70 food trucks in San Francisco. It kind of like, wow, this really could move the dial. And so I'm looking for that situation where it confirms that reality is going to, matter to people in everyday life.
Right. Well, it will be interesting to watch, and we so appreciate you joining us today, Greg, and look forward to having you back.
All right. Thanks for your time today. Take care.
In the US, at least, the wait for regulators to authorize one of the countless applications to launch a Bitcoin ETF doesn't seem any closer to reaching an end. Things in Europe have been a little different for a while, with a small number of exchange-traded products having been in issuance since 2015. Things have taken a leap forward recently, with the first centrally cleared exchange-traded contract being launched and traded on Deutsche Börse's exchange.
Thanks, Nisa. I'm joined today by Gene Moldavsky, CEO of ITI Digital, and Bohrer-Bilowitzki, partner and head of sales at Copper. Thank you both so much for joining me today.
Thanks for having me.
Pleasure to join you.
Awesome. So we're going to be talking about the new wave of exchange-traded products for crypto. A Bitcoin ETF has long been touted as the nirvana for opening up broader access to the asset class, with most of the focus being on the US, where a good number of applications have consistently been rejected by the SEC, primarily around concerns about liquidity, custody, and the unregulated nature of many of the exchanges where Bitcoin are mostly traded. But under the broader category of ETFs, or exchange-traded products, the first exchange-traded note was launched in Europe as far back as 2015, with similar products being listed since then outside of the US. Things moved a step forward in June when ETC Group launched and listed the world's first centrally cleared, BaFin-regulated Bitcoin exchange-traded product on Deutsche Börse's Xetra exchange in Germany. A little more recently, London-based crypto infrastructure provider Copper also launched an alternative product that similarly simplifies the issuance of institutional-friendly instruments that can track crypto assets without the need for direct exposure. So, Gene, I mentioned earlier that yours isn't the first ETP on the market. So can you explain how your product is different from something like Grayscale's, which our viewers may be more familiar with potentially, and maybe give us a sense of what's the difference between an ETN, an ETC, an ETF?
Okay, great. Well, why don't I start with the second question, because I think that's, there's some misconceptions. So in the mainstream market and traditional markets, you have exchange-traded products, ETPs, and there are a number of different categories of these products. Exchange-traded funds, ETFs, are typically in the US can be a basket of different securities, or it can be a mono security. In Europe, an ETF cannot be a mono product, meaning there cannot be one particular asset in it. What we've done is issued and together with our partners, what's called an ETC, which is an exchange-traded commodity, right? A lot of people know and use ETCs, for example, to invest in gold. And since Bitcoin essentially is a commodity, we're using that structure, and that structure is being done out of Germany, which is now very much of a regulated and crypto-friendly European jurisdiction that's also passportable across Europe. So our product is different in the sense that it is, as you mentioned, centrally cleared. And unlike other products, we don't want to talk about competitors, but for example, Grayscale, which of course is one of the best known products, and obviously they have a leader advantage in the US. But if you look at the structure of it, it's a private placement of a trust It's not a regulated product. And it also trades at a premium. Our product is very simple, although it is very well structured and regulated. You essentially get access to Bitcoin. It's very simple, and it works very well for institutions and for retail. And I'll get more to that when we talk later.
Okay. So, Boris, your platform enables the issuance of something called an actively managed certificate. What exactly are these, and what niche do they fill?
We're really very much focused in order to enable anybody that is running a crypto strategy to go after the traditional space and raise capital. That, of course, with the custodial infrastructure that we have built was the first step. With a new product that you surely have heard about and has also been online with Clearloop, where we basically enable post-trade settlement, but still having the ability to trade on exchanges. That's another thing. But ultimately, when it comes to actively managed certificates, it is ultimately the possibility for an asset manager, a crypto strategy, but also in the traditional space, but I'm going to touch on this a little bit later, to issue a product that has an ISIN, is euro clearable, bankable with an ISIN number, and enables, to look and smell like everything else that you in the traditional space are buying and selling on a daily basis. So that is ultimately really what it comes down to, because if you look at it from I think the overruling topic here has to be that after all that work that has been done in that space, from an infrastructural perspective across various sectors, the consensus is there that crypto is a asset class in its own right, which has its place in a well-diversified portfolio. And ultimately, it really comes to the access of those. And there are different things, really touching on what Gene said earlier. If it's an ETN, an ETC, an ETF, there are different ways that you can that you can structure that. And AMC is just another way in order to get that exposure without physically having to own that from an investor perspective. And that's ultimately it.
Okay. So, Gene, we spoke earlier about regulators in the U.S. having thus far been quite reticent to give the green light to an ETF in the U.S. You're regulated by BaFin, which is definitely not a light touch regulator. So what was the process like to get approval? And what did you encounter were BaFin's biggest concerns, and how did you satisfy them?
Okay, great question. Having looked at that, as a shareholder and a partner, it was indeed a very difficult process. But I think what was going for us, and where we were a bit lucky in our respect, was that Germany actually came out, I think, in March with regulations in place with essentially making crypto and digital assets fully legal. And that was a big breakthrough for us.
Yeah.
So on the back of that, approval, the regulator didn't have much of a choice but to sort of get through it. But it doesn't mean that we didn't go through 15 drafts of our prospectus. It didn't mean that we didn't have to deal with issues such as because BTCE is an instrument that actually represents 1/1000th of a Bitcoin. And so when we had to file documents, and the documents had to be transferred to their computer systems, they had to change code to allow for 8 digits, which they never had to do that before, because securities don't trade in 8 digits. So that wasn't part of the old system. So it was an interesting experience, but went through it. I think at the end of the day, the regulator really worked well with us and helped us to finalize the structure, which they approved, right? And we had to, I would say, in some ways, use an existing precedent structure, which was the Xetra Gold ETC. But we added, little bells and whistles to that structure, like an independent trustee, which has pledged over. So, so there's the pledge of the assets. So anything happens, bankruptcy, God forbid, the investors always have access to the underlying asset, which is very important, which is unlike other instruments that are more synthetic in nature. There's an independent administrator essentially there as well to protect against white crime, for example. So, as a new asset class,
independently audited and administrated.
Yeah, absolutely. Yeah, we have an independent. Okay. We have an independent trustee. We have an independent administrator, and we have an independent auditor, which is Ernst & Young. So a lot of independence required to make sure that the product was both institutional and retail proof.
Yeah. Well, one of the questions that the SEC has been asking, centers around both custody and liquidity. Those are their main concerns, right? So from the custody space, who's safeguarding your assets? Where are you sourcing your liquidity? Who are the authorized participants or the market makers that source liquidity on the fund's behalf? How are you guys managing those two things?
Sure.
Custody and liquidity.
We don't want to talk about the SEC because the SEC is the SEC and they have their own, approach and methodology. Of course, we can only talk about BaFin, and that's what we know. And the structure that we came together that worked for us and for BaFin, was involved best in breed custodian, which was a company called BitGo. They're regulated, and they are also insured by Lloyd's. So, that gave them, the regulator a lot of confidence. On the other hand, in terms of liquidity, what we've done, and that was an integral part to BaFin getting approval, was that we've brought in, best-in-class market makers. So folks like Jane Street, XTX, Flow Traders, which are, professional market makers that do billions on Xetra, for example. They're part of our consortium. Some of them are actually part of our shareholder structure. So they're there professionally creating markets and making markets. They're also authorized participants. So for all the trading that they're doing, they can go back and create these certificates and make sure that each certificate has the right amount of Bitcoin behind it, again, stored in Bitcoin. So it all works as as one package that gives institutional investors the ability to know that that they can get liquidity if they need to, and as well as retail.
Okay, so Boris, let's jump over to you and some of the same questions. How do things work for AMC?
When it comes to the custody, like to have a deep dive there. In simple terms, we're MPC enabled. It's which is the two key things there, that the private key ultimately has never been created nor reassembled centrally. So that's from a custody perspective very important. Like I've heard now BitGo mentioned earlier. Every bolts and whistle that comes with it, with insurance, etc. You of course have with copper as well. Now, the ultimate question that needs to be asked here is who benefits this? From auditors and from a setup perspective, it's very cheap. If you go through the classic setup of a fund, it can cost you 150 grand with like legal fees, etc. All that is being done within that issuance platform already, where you've got Matheson and Simmons & Simmons on the legal side, AAC when it comes to audit. But ultimately what it is the ability for you to distribute this across Switzerland, the UK, the EU. You even have the ability of going retail and listing this. So you've got like Germany, Italy, Austria, Liechtenstein, Luxembourg, and I think Ireland, that you can also go retail. But I kind of asked that question earlier, like who does this benefit? And there are several points that you need to have to look at here now. So one of the big ones, of course, is traditional asset managers. You are looking after money of high net worth individuals, investors in general, who are asking the question that, pure fixed income and equity exposure is not enough anymore. So what ultimately is happening for those guys is that they are faced with the inevitable of like saying like, look, 2-3% of what I have with you now, since you can't service my demand, has to leave, and we need to put this into something that is giving me exposure. You've got the two options, of course, getting physical exposure and dealing with, figuring out of how blockchain works and all this stuff. And I'm saying this from that perspective because that's what the traditional guys have to figure out. And, not everybody is proficient in it. Or you basically buy into something that does this actively for you.
We've seen a large increase in volumes on CME futures. which is typically where the institutions have been comfortable gaining exposure. What benefits do these instruments offer over futures? And are you targeting the same market of clients?
Well, I think that, there's obviously room for futures in any market, right? Any asset class, whether it be traditional assets or, digital assets. So I think that, it depends on the mandate of the investor, of the institutions. And there's room for both, right? And I think that, we, with our product BTC, are, focusing on a very entry point, I would say, potentially, for institutional investors and retail investors to be able to buy a fully regulated MiFID II instrument with underlying Bitcoin, in this case, asset, with professional market makers creating liquidity and tight spreads, which is obviously important. It is a centrally cleared central counterparty CCP instrument versus a bilateral settlement, which a lot of the other instruments have, which gives investors comfort because there's no settlement risk. Essentially, it's insured, as I talked about before, trading on a major exchange, the biggest ETP board actually in Europe. So this is a simple way to get in if you want to just go long, or hold or trade Bitcoin. And in fact, today was actually it's good timing because we hit our first day with over $1 million euros, actually, because it's on Germany, euros of trading, right? So we're actually seeing pick up. We're seeing institutions coming into the game, and it's a good entry point. And there's room for derivatives and there's room for futures.
Anything to add on that, Boris?
And an investor is always a very, very interesting creature because, one's kind of having made its mind up to get exposure to a certain asset class, he also at the same time wants sophistication when it comes to the strategy. Now, when it comes to the sophistication of those strategies, again, being able to access the sophistication via a instrument that looks and smells like all the other stuff that he's buying is very enticing. So yeah, I mean, it has room for both, and more than enough room actually. But like I say, from a simply enable perspective, we are both pulling on the same string here, even though that the strategies that are being offered within the AMCs that are being issued on our platform are more sophisticated.
Brilliant. Well, we have run out of time. Gentlemen, thank you both so much for joining us. Back to you, Nisa.
Next up, Philip Gradwell's back for this week's Onchain reaction.
Thanks, Nisa, and welcome to Onchain Reaction. I'm Philip Gradwell, the Chief Economist at Chainalysis, and it's good to be back after a bit of a break. I'll be back on Coinscrum markets about once a month over the next few months. It was good to take a bit of time away because really not much has been happening recently. We had the first major Bitcoin price move in around 2 weeks on Tuesday this week, the 21st of July, but the price remains close to its 90-day average. And Bitcoin inflows into exchanges, they've just kept falling lower. They're now around 54.4 thousand Bitcoin per day on average, suggesting that supply is low if demand rises, as it may have done with that big price increase that we just experienced. However, interestingly, there was an increase in exchange balances on the 20th of July. Given that inflows have stayed as normal, the fact that there was this increase in exchange balances suggests that someone who was typically going to be taking their Bitcoin off the exchange kept it on. So those outflows paused just prior to the price gains. It's not just Bitcoin. For Tether, there was also a large inflow into exchanges on the 20th of July, which was boosted by the arrival of $66 million of new issuance, although a lot of the Tether coming onto exchanges was obviously from other sources. So even though there's been some price action very recently after a very quiet period, with this interesting pattern of Bitcoin and Tether going on exchanges beforehand, I just don't think price is likely to change that much in the future. And the reason for that is that assets are just increasingly being held for longer and longer. If we look at Bitcoin, Bitcoin Cash, Litecoin, Ethereum, and Tether, well, over half the supply of each asset has been held for more than a year, other than Tether, which tends to move around a lot more. And because there's been so much more Tether issued on Ethereum recently, that Tether is quite young. To give you a sense of just how the different assets are aging, Bitcoin had a 2 percentage point increase in the percent of Bitcoin being held for more than a year in Q2 relative to Q1. So in Q1, there was 54% of all Bitcoin had been held for more than a year. In Q2, it's now 56%. So all of our cryptos, they're just aging. And it's not just that Bitcoin and other assets are being held for longer. They're also increasingly illiquid. That means they're held by entities who tend to receive more than they send. So they're really holding on to most of their assets, acting like sinks, taking the crypto out of circulation. And even Tether has become more illiquid in Q2, with 51% of all the Tether issued on Bitcoin and Ethereum illiquid. And that was a big 19 percentage point increase from Q1, where the share in illiquid entities was 32%. And that for me is very interesting. Suggests that Tether, which typically has been used as a way of transferring value between exchanges, has always had a very high velocity, potentially even used as a means of exchange, could now be being used as a store of value. So in summary, Bitcoin did experience its first price increase in 2 weeks, or first major price increase in 2 weeks. Interestingly, some Bitcoin and Tether was being held back on exchanges before that increase on the 20th of July. Just some interesting timing. It was a big, sharp jump, so may have been some people who were waiting for something to happen. But even despite that recent move, it does look like people are really in a long-term buy and hold position, with even Tether acting more like a store of value. There's still a lot of macroeconomic uncertainty. Feels like that is affecting crypto just as much now as it has been for the last few weeks. So thanks for joining. It's back to you, Nisa.
Thanks, Philip. You've been watching Coinscrum Markets. Thanks so much for joining us. See you again next week.